any attempt to control a market, to control reality with factors that aren't part of reality, manipulation, in other words, ultimately fails because reality always wins in the end. And the longer you restrain reality from doing what it might otherwise have done, then the more compression you've built into that market. In the case of silver, catching up to a price level that would be reflective of, for example, the decay in the money unit, or reflective of what gold has done for 50 years, meaning higher and higher highs, not capped off for 50 years.
This is not a normal pullback, and Michael Oliver is very clear about that. Silver has not failed, it has recalibrated. After ripping to a record peak near $122 per ounce, silver has pulled back sharply into the high 70s and low 80s, triggering exactly the kind of doubt and disbelief that historically marks the midpoint of a true secular move. According to Oliver, this correction arrived sooner and deeper than expected, but critically, it did not violate the structural integrity of the breakout. In his framework, this was not damage control, it was pressure release inside a far larger acceleration phase. What makes Oliver's analysis especially compelling is that he is not framing silver's trajectory as a speculative spike, but as a long overdue adjustment to monetary reality. Silver has spent decades capped inside an artificial $50 ceiling while gold, copper, and other real assets broke decisively into higher price regimes. That suppression did not eliminate value, it compressed it. And when compression finally breaks, price does not drift higher, it resets violently. Oliver argues that this reset is now underway, and that the real move, the move that matters, still lies ahead. In his latest conversation with Daniela Cambone, Oliver makes one of his boldest projections yet, silver moving into the hundreds of dollars, potentially between $300 and $500 before the end of the first half of the year. Not years from now, not after some hypothetical crisis, but within months, despite the recent sell-off, despite the volatility, and despite renewed attempts to drag silver back into the old $50 paradigm that defined the last half-century. In this interview, Oliver walks through the anatomy of the correction, the momentum structures that held precisely where they needed to, the failed attempts to reassert control over silver's price, and the deeper forces driving what he calls a rebirth into a new pricing reality. If you want to understand why this pullback may end up being remembered as the final shakeout before an historic move, and why silver may still be radically underpriced even here, stay with us.
It came sooner than we expected. We have various reasons, I probably talked about in the last show, of why we think this move in silver, the bell rang in the close of November for us, meaning that's where the point of massive acceleration was likely to occur. So December would be month one, January month two. In hindsight, looking back at various markets who've undergone similar things, quite often these surges, and there's reasons for this in silver as well, are spent in a couple quarters, either side of a couple quarters, 5 months, 7 months, something like that, where you see the massive move that it's going to make done quickly. Oh, there might be some more later, but that's not the point. The point is the massive surge, the rebirth to a new reality for silver. Well, we're only month two into it. In the last day of that month, we had a huge collapse. Came a little sooner than we expected. We kind of thought maybe late February, early March, and it was deeper than expected. But in hindsight, when I go back and I look at a lot of my momentum charts, again, you can look at price if you want, that's fine. But when you look at momentum, often you get a different picture. And that pullback made a lot of sense, actually, where it went to, both on gold and silver. And lo and behold, that was the low so far that occurred Monday morning. The following, it was a day and a half collapse, really. It was the last day of last month and then the first day of this month. But we got to certain levels on silver and gold, which made sort of sense. Oh, they pulled back to there. Oh, that makes sense. Yes, it was dramatic to get there. Since then, we've gelled. We've had up and down action. And frankly, where the rally peaked so far this week, up above $90 in silver, made some sense too. And then we pull back from there. So we more or less set a structure, so to speak. One, we held a key long-term support level, actually an intermediate term support level, 3 month average on silver to the penny. Okay, we hit that on Monday. And we came back and retested today. If you take it out a little bit, it doesn't bother us. But that was an interesting area to stop at because we have not seen that rising moving average, a 3-month average, which is not a common tool. We use it. We've not seen that in since, like 8, 9 months in silver. So, I mean, it hasn't even come back down and kissed that rising average. So it made some sense to us. Okay, that's step one. What we're looking for now is some gelling action. No, I don't think we're going to go zapping back to the high within weeks. I think it may take more like much of February to work our way back up to restabilize a lot of expectations as well, but to restabilize the market and generate some buy signals on the way back up based on short-term metrics. And those numbers are set. For instance, you don't want to, if you're a bear, you do not want to wander back up late this week and into next week into the upper 80s again on silver. We were up to over 90 the other day. So you don't want to go back up there again. If you do, then it's over. You're going back up, okay? And I think that's about to happen. But again, I don't think it's an explosion back to the high. I could be surprised. I think it's more like an arm wrestling match to get back up there, and probably by March, then you're challenging the highs again, and which game on again, in other words. That would have been your midpoint jiggle. And I still think that the likely massive percent of any gain we're going to see, and again, I think it could be in the couple to several $100s on silver easily. I don't have a precise number. Will occur by early summer.
You put that range between 300 to 500.
Yeah, like
correct?
6 months. If you start in November and you count the months, you got
Right.
Jan, Feb, March, April, May, June, okay? Give or take a month, okay? These same type of events, this explosive couple quarter surge, also occurred for silver back in 79 to 80 when it went to 50 bucks. In 5 months, you quadrupled silver in 5 months to get to 50. Again, that was within that old reality of 50-buck highs. And then
Right.
again in 2010 and 11, there was a last surge of a multi-year bull market in silver, where in September 2010 through April 2011, silver doubled in half, okay, in 7 months, so 5 months, 7 months, either side of a couple quarters. And we could find this behavior pattern in other markets, and I mentioned this last time, but we won't reiterate that. But right now, I think, one, yes, the correction is either over or largely over. Two, it won't take much to put a real thumbs up on this situation, like, okay, we're going back up. I don't think the back up means rapidly. I think it could be arm wrestling. That's fine. But by March, if we have a stable February, which so far I think we're going to see, then by March, you should be back at your highs. And at that point, you go ballistic. Except this time you will have shaken out a ton of people and created massive amount of doubt, which is great. You
Shook out the weak hands.
yeah. And you want the doubt because when you get these kind of price surges, you don't want everybody on board from month 1 through 6. You want them to come on board in month 5 and 6. You follow me? Where everybody says, I got to be there. And they join in late.
Oliver's focus is not on the drama of the decline, but on where silver stopped. The collapse was fast, emotional, and unsettling, but technically precise. Momentum indicators, not price headlines, define the low. Silver and gold both pulled back to levels that made structural sense, tagging rising intermediate-term averages almost to the penny, something silver had not done in many months. That, in Oliver's work, is not weakness. It is confirmation that the larger trend remains intact and that the market is transitioning from shock to consolidation. What comes next, he suggests, is not an immediate vertical surge, but a period of gelling, an arm wrestling phase where expectations are reset, weak hands are removed, and the market rebuilds energy for the next leg. And that sets the stage for the second timestamp, where Oliver addresses the bigger question investors are quietly asking: whether this move was merely speculative excess, or whether decades of suppression are finally breaking. And what happens when reality reasserts itself after being restrained for 50 years?
Michael, do you think there was anything nefarious behind the silver move?
Could be. I know there's something been nefarious for the last 50 years, or especially the last decade or so, to cap it again at 50. So the old reality was going to prevail. Well, it didn't. Okay, so whoever thought they could cap it with whatever instruments they used, didn't work. And even now on the pullback, it's still not back to 50. Okay, so any attempt to control a market, to control reality with factors that aren't part of reality, manipulation, in other words, ultimately fails because reality always wins in the end. And the longer you restrain reality from doing what it might otherwise have done, then the more compression you've built into that market. In the case of silver, catching up to a price level that would be reflective of, for example, the decay in the money unit, or reflective of what gold has done for 50 years, meaning higher and higher highs, not capped off for 50 years. But, you know, when you look at silver and you see a 50-year range, $4 to 50, $4 to 50, and yet other markets during that same time didn't stop at the 1980 high, didn't stop at the 2011 high. Look what copper did for decades. You know, I've mentioned this before, 50 cents to $1.50 for decades and decades. When it broke through in a couple quarters, it went to 450. It's back in 2006. Lead did the same thing in 2007. Gold, the mama market of the monetary metals, has not restrained by the 1980 high, nor the 2011 high, where silver was. Why? It just doesn't make any sense. If copper can blast into highs above a multi-decade range, why can't silver? Well, it reeks of manipulation. The question now is, did this break occur that way? It could be. It could also be to late comers who came in, because see, our buy signals at MSA were approaching $35 last June, coming back up towards some highs it had made before, above 35. We said expects acceleration. Well, okay, $35 accelerated. Then the next signal was that November close. And that was when silver broke out versus gold. And it said, hey, I'm coming back to reality. I'm too cheap compared to you, Mama Metal. I'm going to join you. And so the little monetary metal exploded in relative value, but it's still cheap versus gold. Very cheap historically. And we think it's going to regain some of its old norms at much higher percentage levels versus gold than we've seen so far. So neither the price of silver advanced nor the relationship to gold being depressed and recovering, neither of those have reached levels that make sense to us in terms of satisfaction.
What do you make of some quite prominent people in our industry who are vocal about the fact they sold all their position in silver at around 90 and, you know, want to get, you know, just say, you know, I'll get back in when it's low again?
Well,
Any opinions there?
No opinions. I think too many analysts, including those who are friendly to gold and silver, fundamentally friendly, are using old metrics. Now, they're going back and looking at their charts, 1979 to 80 and 2010 to 11, and they're seeing these massive up moves, of course, confined in that old range. And yet they looked at their metrics that they might have on their quote screen, like, let's say, RSI, for example, a very popular free tool. Okay. It gets above 80 or something on a monthly close. Oh, that's overbought. Well, no old norms are going to be shattered in this move. Just like price has shattered the old 50 highs, you're going to break old norms of what is overbought. And we show this in annual momentum charts of silver and gold. What used to be the old highs, like the 2011 high and the 2020 surge high. And you look at momentum charts and you say, oh, see, they sort of capped at the same level. Well, we blew those off the page. So what the market has said is old notions of overbought are incorrect. And therefore, people who take profits based on that, for the moment, they feel wise. We're arguing, no. Ultimately, they're going to have a real problem. Do they actually get back in? And if they get back in, do they get in better than where they got out? You know, that's...
Well said. Well said.
Yeah.
Help me solve this mystery. I'm going to fire in the chart here of Shanghai silver price in dollars. As I'm looking now, there is a $30 spread. Michael, what in the world is going on here? Why?
Well,
Why?
We know the Chinese want silver. We know they want it as an industrial metal in particular. The Indians want it as a monetary metal. In fact, they're remonetizing silver as money. They've already done it. But China is the world's biggest producer of solar cells. And throughout the developing world, solar panels are very important because you don't have a local power plant, you know, and you were a rural community in Africa or in South America somewhere. So therefore, having your own solar panel is essential for you to have your cell phone and all kinds of other things. And the Chinese have capitalized on that market. They produce like 80-90% of that. And it's essential to have silver in the, forget what they call the tubes if going to the solar panels and photovoltaic cells. Also, silver is essential in the AI industry and the expansion we're hearing about. It's here, there, and everywhere in high tech. Little bits, but everywhere. And therefore, it's not recycled either because it's there in small amounts and it's never worth recycling. So once it's gone, it's gone. You know what I mean? Demand there is overwhelming supply in both those categories.
Yep.
And it's not been satisfied for 5 years, and it's not being satisfied this year in terms of supply meeting demand. So that's why China probably has a premium. Plus, I think they've banned exports of silver. And once they get it in there, it stays there. So that could explain that. But that is not really the be-all and end-all of what this is about. The be-all, the silver's a surfer, and he's riding on two waves. Now, right now, everybody knows about the industrial supply-demand deficit. That's been made clear to investors. And so, and the China situation. It's money. It's also the baby of gold. 3,000 years it's been that. Don't dismiss it. And when the world gets shaken by this and that other event, like the decline in the dollar's reserve status versus other fiats, the questionable nature of U.S. government bonds, and especially Japanese bonds or UK bonds, these are crises bubbling on the edge. And the monetary metals know that. And they're not going to wait for the event to happen in this category or that category. They're already building in their anticipation of those events aren't going away. It's just a matter of when do they burst.
Michael Oliver's message in this interview is ultimately not about timing a trade. It is about recognizing a regime change. Silver has spent half a century trapped inside a $4 to $50 range while monetary debasement accelerated, debt exploded, and gold steadily marched higher through every supposed historical ceiling. That divergence was never natural. It was engineered, reinforced, and defended through paper markets and derivative structures that treated silver as an anomaly rather than a monetary metal. Oliver's view is blunt. When markets are restrained from expressing reality, the eventual release is not orderly, it is violent. What makes this moment different is that silver is now breaking free on multiple fronts simultaneously. On a relative basis, silver has begun to outperform gold, signaling a reversion toward long-term historical norms that still sit far above current levels. On a physical basis, premiums in markets like Shanghai reveal stress that cannot be arbitraged away indefinitely. And on a macro level, silver is being pulled in two directions at once. As an industrial necessity in solar, AI, and electrification, and as a monetary asset reacting to the erosion of trust in sovereign debt, fiat currencies, and reserve systems. Oliver is particularly critical of analysts who continue to apply old, overbought metrics to a market that has already shattered its historical boundaries. When price regimes change, momentum regimes change with them. What once looked extreme becomes normal, and what once triggered profit-taking becomes the fuel for acceleration. In that environment, selling because something looks high often results in being locked out of the most consequential phase of the move. The risk, as Oliver frames it, is not holding too long. It is failing to recognize that the definition of expensive has fundamentally shifted. His optimism is not blind enthusiasm. It is grounded in precedent. Silver's most explosive advances have historically unfolded over compressed time frames, 5 to 7 months, following prolonged periods of suppression. We saw it in 1979 and 1980. We saw it again in 2010 and 2011. And in each case, the majority of gains occurred late, after corrections shook out conviction and created widespread doubt. That doubt, Oliver argues, is not a warning sign. It is a prerequisite. The broader implication is hard to ignore. Precious metals are not reacting to a single catalyst, but to a constellation of unresolved stresses. Weakening reserve currencies, unstable bond markets, ballooning sovereign debt, and a growing recognition that financial repression cannot be sustained indefinitely. In that context, silver's role as both industrial lifeblood and monetary metal becomes uniquely powerful. It is not replacing gold, it is catching up to it. If Oliver is right, The recent pullback will not be remembered as the end of the move, but as the moment when the market tested conviction before resetting to an entirely new reality. That is why this period matters. That is why volatility matters. And that is why, in his words, reality always wins in the end. If you found this analysis valuable, take a moment to like the video, subscribe to the channel, and share it with someone who still believes silver belongs in the $50 box. Let me know your thoughts in the comments, especially whether you think this correction has already done its job. Thanks for watching, and I'll see you in the next one.